research at Renaissance Macro Research. Neil, thank you very much for joining us. What's your headline takeaway from these numbers? I'll just remind viewers how these numbers came in. Headline inflation comes in at an annual pace of 2.4% in March. That is weaker than expected and a big step down from 2.8 in February. Core inflation, which excludes food and energy, comes in at 2.8%, also a significant step down from February and also less than economists had expected.
Well, thanks for having me. I don't think it really changes much. It tells you that before this trade war kicked off, we were making progress on inflation in the U.S., particularly with respect to core services excluding housing. That's the thing that the Fed has been sort of focused on because it's very much tied to the labor market. And what it shows is it's basically just a reminder that there's not really much inflationary pressure coming from the jobs market. I would note that, we did see another big increase in egg prices that probably kept food at home costs elevated. There is a lag between, wholesale prices for eggs and what you feel at the grocer. And that's probably going to drop like a rock in the April number. There is some pipeline of improvement going forward. But I think from the perspective of the fixed income market, we're basically in wait and see mode, just like the Fed. The Fed is waiting to see how tariffs and the president's trade policy affects consumer prices at a time when the unemployment rate still remains low. That basically is conditioning them to be behind the curve at this point. So, that's kind of where I'm at. I don't really think the data matters all that much for the markets, and I think that's one reason why you haven't really seen much reaction. Normally, if we got a number like this, we'd probably see a much more meaningful rally, on the announcement. You haven't really seen that this time.
Yeah, I agree with you, Neil. And if you'd seen an improvement on the core by 1/10 of a point or something like that a few months ago, you're right, the markets would have popped. And all of this seems to be in the rearview mirror right now. But going forward, now, what would your interpretation or expectation be from the tariffs? And this changes on a daily basis as well, but the tariffs as they're announced right now on, Canada and Mexico, obviously, and the 10%. In terms of how it impacts the economy and inflation and obviously the Fed's division, do you think it's more of a negative on higher inflation, or do you think it's more that it'll drive growth down and increase recessionary fears, which would bring the Fed in? Which is sort of, the bigger weight you think that we can see in the short term on what we know now?
Well, it's both. A tariff by definition is a negative supply shock, right? So you're going to get growth weakness and, price increases. That being said, I think the inflationary consequences probably are felt first, and then that'll drive the growth story down later. I would just point out to your viewers, it is interesting that how much the markets kind of popped yesterday on the president backing off, his reciprocal tariff agenda for the time being. I would just point out that the effective tariff rate, when you do the math, doesn't really change all that much. Remember, the United States still imports a lot of end consumer goods from China, apparel, household furniture, appliances, things like that. And, those coming in at 125%, is not going to be pleasant. Decoupling is painful. And so I think, it's important for people to kind of remember that even though, we came off the brink, the effective tariff rate is more or less where it was to start the week. So I don't think much has really changed. And you can make an argument, given the nature of who we're putting the higher tariff on, in this case, China, that actually might hurt us more from, a consumer price perspective. I think for the Fed, that just reinforces this conditioning of being behind the curve.
Okay, last question. As you know, the Fed funds futures market is betting heavily on a rate cut from the Fed in the middle of June, and the bets become more substantial as the year goes on. It wasn't that long ago that the market was not pricing in a Fed cut until the very end of 2025. What do you think is the path of the Fed?
I mean, I think June makes sense. I mean, at this point, if I had to, really, if you had to put a gun to my head, I'd say maybe they push it out a month, because I think the inflationary consequences, have gotten a little bit worse at the margin from tariffs. June is possible if you basically, I mean, I think for your viewers, what's important to understand is that the Fed is no longer being proactive, right? They're being reactive. They're basically waiting for permission from the economic growth data to cut. That's essentially tempting fate. If you're waiting for bad news to materialize before you cut rates, the chances are is that the bad news will materialize. So my expectation is that the Fed will end up cutting, but one of the reasons, unfortunately, why they'll be cutting maybe a little bit more aggressively is because they're waiting longer before they actually get going. And I think that, to me, is the important story.
Neil, thank you so much for joining us this morning on this data. Neil Dutta is partner